of all, very good evening to everyone. I know at InCred, thanks for the opportunity. So with regards to the Indian equities market, I think constructively, when you look at slightly more longer term orientation, we remain constructive, largely on the back of the fact that you have all the basics which are in place. The working age population is actually increasing quite a bit for the next decade and a half. You have the right demographics, a fairly stable regulatory regime, policy perspective also takes up fairly stable, and you have the external situation also reasonably good, with very high forex reserves, and balance of payments is also now under control, with oil remaining at a fairly comfortable level. I think all this kind of position Indian economy now fairly in good footing, and that's where I think the opportunity for companies to grow is kind of quite conducive. This, if you compare with any other country in the world, I think you would possibly say that we are possibly in the best possible position at this point in time. And to that extent, I think corporates today will have to only focus on their business to a large extent to deliver the kind of earnings that they can to the best of their abilities. Under this kind of a construct, I think we've been quite positive about the Indian markets. But when you take a slightly more longer term horizon, I think we remain very, very constructive about Indian markets. Yeah, great question, right? So with regards to both growth and value investing, I think investing at the crux of it, I think we try to keep things fairly simple. What do typically markets like? Any stock to do well, there can be period of things growth, there needs to be it's a function of earnings growth and PE, right? So if the earnings do well, they will improve. Now it's a very, very simple mathematical function. How this kind of progresses, it's not only these two things that are important. What also the third element that's also important is, even if you get the first two factors, you also need to get them at the right risk reward. If you don't get that aspect, then you could possibly be not positioned well. Now, under growth investing, you typically are chasing businesses which are delivering very, very good earnings growth. But under value investing, you're basically buying businesses, good businesses, but that are currently out of flavor. Though they could be out of flavor for variety of reasons, but largely when you're looking at good businesses, you need to identify them and own the ones which are run by good, able managements. But they're going through some temporary issues, largely with the fact that there could be a sector or a macro uncertainty which is possibly plaguing their fortunes on a temporary basis. So what's important here is we need to buy these businesses at a reasonable price. That's how we typically look at it. Value investing does not mean buying mediocre businesses at a bargain. So one needs to make that differentiation quite distinctly, and that's very, very important. That's what we do. Otherwise, if you end up doing that, then you could actually be setting yourself for a value trap instead of a value pick. So that differentiation is quite important, and typically value traps tend to have two common factors. Either they are in a business which is kind of on a perennial decline. They're operating in that kind of a structure and they're not doing anything to change the business model or reinvent themselves, or they're not allocating capital well. So I think these are the two important. Typically see for businesses to go wrong or stocks to become value traps. These two functions are, what happens, possibly you could call them as recipe for value traps, the two important elements. So otherwise, actually, coming back to the factor on value investing, I think it's all about identifying good businesses, buying them at a reasonable price, but typically when they're out of flavor, that's when you get them at a certain value. So, value strategy and, companies that are at a, certain value, you typically tend to find them irrespective of what sort of market one is in. It's just that, and in every sector, you actually have pretty good managements, that run good businesses. But due to various external factors, there tends to be, from time to time, businesses that go through which are out of flavor in the market. Say, for instance, today, when you look at consumption as a space, possibly some of the well-run businesses are possibly out of flavor. But these are by no means, not great companies, not run by, they're run by very, very able managers. So that's, one aspect of it. Similarly, if you take 10 years back, then B2B businesses used to kind of go through a similar phase. But then over a period of time, people tend to have a lot of recency bias to, the way they have kind of approached these companies, and tend to think at some of these as, perennially growth names or perennially, value names. That's not how one should ideally be looking at it. One should be very data dependent. And if you're data dependent, you will ideally see that, if you follow earnings growth, if you follow, ROE improvement, and if you get them at a reasonable risk reward, I think that process helps you identify some of these aspects a lot more, better. I think in that sense, one has to be very, very process oriented and have a good investment framework. At our end, we have what we call as the, BMV framework, which is kind of held us in good stead, pretty much in the long run. So we do that. Different people will have different strategies, but what works for us is what we call as the philosophy, which is business management and valuation. That's a very, very central aspect to investing. At our end, like I earlier alluded to, we follow what is called as a BMV, which is business management and valuation. So typically, when we pick a business, we look at what sort of, is it a market share gainer? That's quite important because it's a company. We should ideally be with companies who tend to work towards adding value to the customer. Only when they add value to the customer do they tend to gain market share. So that's quite important. Second, what we also look for businesses is they need to have some sort of a sustainable moat in their business, a competitive advantage. All competitive advantage, if not worked upon, continue on a continuous basis, they tend to erode. So if it's, for example, a technology company, then R&D spend needs to be in place to ensure that competitive advantage kind of sticks over a period of time. If not, then competitors do catch up. Or if it's a consumer business, then you need to ensure that you get the share of voice and share of mind with the customer. So you need to invest into A&P. So if that's not there, then again you lose that share of voice and share of mind. So in that sense, it's quite important that companies continue to invest upon strengthening their boards. And then the other elements are, from external environment. If there are any perceivable changes at the margin which can, add positively to the business momentum, we also look for that. These facets is, largely what we look for in a business. As far as managements are concerned, I think what we centrally look forward to is their capital allocation track record. Because that's the foremost function why capital markets in fact exist. Because investors allocate money to asset managers like us, whereas we in turn allocate money back to corporates. So in that sense, that's a central function that everybody is actually doing, and the reason why the capital markets actually exist. So that track record is quite important. That's what we look for, and how their execution has been on that. Once they've decided on how to allocate capital, how they executed that in the business is what we look for. Finally, on the valuation side, we typically look at financials. More liability side of the balance sheet is what we pay a lot of attention to. And similarly on cash flows, these two are important facets. P&L is largely a flow through, so our very, very high attention is paid to balance sheet and cash flows. And when things make sense on those factors, the risk reward makes sense. That's when we tend to evaluate the business and invest in them. So this philosophy is kind of is very, very bottom up rather than being top down. And to that extent, it helps us identify good companies, identify what's the intrinsic value, and when the opportunity provides itself, we are able to participate in these names better over a cycle. Now, while we do that, it's also important to ensure that you have good risk management practices. So we have a fairly strong risk management team at ICICI Prudential, and they have an independent review of risk that the portfolio kind of carries. It's carried out at multiple levels. So there are factors, obviously, like percentage of the position within the portfolio, or percentage of the company that you possibly might be owning at an institution level, or a number of days of liquidity that might be required to liquidate a certain position at a certain percentage of the volumes. So there are multiple different factors that are kind of taken into consideration. And there are also factors which could be common across certain businesses. So if the portfolio is running unconsciously some sort of commonalities and high correlations across those factors, those are also looked into. So it's a very evolved risk management practice that we have, and it's done independently on a monthly basis. So that holds us in good stead, and also helps us realize what's adding alpha to the portfolio, what's adding value to the portfolio on a consistent basis, and what's sometimes taking away alpha or detracting good contribution from the portfolio. So I think that's a fairly evolved process that we have, and so that helps the investors quite a bit in the long run. No, great question. So typically, when you have growing businesses, you tend to believe that the capital requirement also kind of increases when there is higher growth. Because if it's capital intensive, then you deploy that capital into fixed assets, or if it's working capital intensive, then you deploy that capital into working capital. Conversely, people think that if it's a value business, then typically it's in a mature industry, so you're not growing that fast, and you tend to your requirements as far as incremental capital for either capex or working capital tends to be on the lower end. While broadly this is on the same page, I think it can't be generalized, because sometimes there are very high cash flow throwing businesses also which are available at a decent risk reward. They could be there for some temporary reason, for external reasons. So there are circumstances, so we wouldn't want to generalize. But if it's a slightly slower growing business, and if there is no incremental requirement of capital, then dividend tends to be higher. So that's a natural expectation that one kind of has. But that said, I think for our portfolio, the dividend yield is decent, but it's not substantially higher than what the index is. I think the index level, if we were to go by, I think for the broader index, I think on Nifty 500, I think that number is close to 1.1% today. For our portfolio, I think that number is closer to about 1.35 or so percentage or so. So it's not far too different. It's slightly better, but not considerably better. So I wouldn't, say that, because it's a value strategy, that doesn't necessarily mean that it's a very high dividend yield portfolio, because you're also looking at businesses that are, good businesses that are available at a reasonable price. So that's how you're kind of building the portfolio. Learning from mistakes is the biggest learning. I think you'll have to keep trying, because you will do mistakes. Because if you don't do mistakes, you're not trying. So you will do mistakes, but once you do the mistake, learn from it. That's the most important one. And always keep trying, because the way businesses kind of evolve, you will have to keep changing and you will have to keep evolving. And when those changes are happening, then you will have to evolve. So stay true to that process. Stay humble, stay hardworking. I think that's the most important thing. As far as especially this industry, the market keeps you grounded all the time. So it's important to be that way and move ahead. Okay, that's kind of tough, but I would say passionate, hardworking team person. That's because I think it's a lot more about this business is a lot more about how you work well in a team. So in that you need a team to function well. You can't function as a individual all the time. You need to keep learning as a team, and so that's kind of very, very important. I think you need to have the passion, and I think I have that, especially for this line of work. I think I'm quite passionate about how I approach this. So yeah, that's how I would kind of define myself. Yeah.